Hi, hi everyone. Thanks for joining us for the fourth in our series of four board governance building blocks webinars. Tonight's topic is understanding financial reports. I'm Morehouse and I work with the MacKillop Farm Management Group, assisting with comms and events. So this workshop's designed for people who want to transform their board and committees from long and dull to dynamic and productive, and financial reports is just one way to address that. They're the four individual modules. They've been attended either as a standalone or as a series. They've been designed to strengthen individual leadership capacity and capability to support community and drought resilience. By gaining a better understanding of governance, decision-making is improved, increasing community resilience in times of drought. This project is supported by FRRR through funding from the Australian Government's Future Drought Fund. This evening's presentation will be recorded and made available on our YouTube channel within the next week. As a courtesy to the presenter and fellow attendees, we do ask that where possible, your cameras remain on and microphone off. We will have the chat facility available to take questions, and I can let Natasha know when these appear. Feel free to jump in and use this chat function for your questions. I'd now like to welcome Natasha Rees, our presenter for this evening. Thanks, Natasha.
Thanks, Katie, and hello, everyone. And as I go through, we might have more people kind of joining. So I'm doing that component today. So if I pause to let someone in, that's what I'm doing. I will start sharing the presentation. All right. Can you all see the presentation? I can't actually see you anymore. So if anyone has their hand up or is nodding, I can't see. So hopefully you can see the presentation. And if you have any, oh, good. Thanks, Katie. If you have any questions, feel free to just butt in and ask them. But Katie will be monitoring the chat function as well. If you wanted to put something in the chat, she'll interrupt me and make sure that we answer that question. So today we're going to be looking at financial reports, and this is very much looking at financial reports from the perspective of a board member without much financial knowledge or experience. Certainly if you're on a board or a committee that has an accountant or someone with financial background, they would understand the financial reports in a lot more detail than what we're going to cover today. But very much what we're going to look at today are kind of really the kind of what are the things you really need to look out for as someone on a board or a committee responsible for, the overall financial sustainability of the organisation, but you don't have a great deal of financial knowledge or experience. So that's what we're looking at it from today, and certainly that's my experience. I have sat on I currently sit on quite a number of boards, and so I kind of use these what we're going to go through today in my experience as being the simple ways to understand the financial viability of your organisation. So before I go any further, I would like to acknowledge that I'm speaking to you today from Kaurna country. I live in McLaren Vale. And I'd like to pay my respects to the Kaurna people, their elders past and present. And I'd also like to acknowledge the traditional custodians of the lands that you're dialing in from, and pay my respects to their elders past and present as well. So as I mentioned, a little bit about me. I'm a professional impact network member with the Social Impact Hub. I'm currently chair of a not-for-profit disability housing provider here in South Australia, as well as being on a number of national and international boards, including the Medical Board of Australia. And I'm also a fellow of the Governance Institute of Australia. So I have a lot of experience in working with boards as a professional impact network member with the Social Impact Hub, not-for-profit boards, but also sitting on not-for-profit boards myself. So what we're going to be covering today is, as I said, the basics around financial reports and how to make sense of what you're seeing with the numbers, decoding those finances. And we're going to look at 5 key questions that you would want to be asking maybe before you join a board, or when you join a board or a committee, what you can be asking of the finances of that organisation. We're also, if we've got time, going to have a little look at how to create a budget if you're a treasurer of an organisation and you're not really sure how to go about creating and monitoring a budget. We're going to have a quick look at that, and also some tips around applying for grants from a budget perspective, what to include if you're applying for a government grant or a grant from a philanthropic trust for a not-for-profit. And then we'll just cover some key takeaways and have time for questions. So as I said, this really is just general information, and it's not it really is a guide for people involved in not-for-profit organisations in South Australia. If you have any particular financial issue, you really need to seek some expert advice from an accountant or an auditor. And so this can't really be considered financial advice. So I have some interactive elements today. And you can interact with those by logging into Slido, and I'm going to have a QR code in a minute, but if you don't have a phone handy, or you want to be able to do it by opening up your internet browser, then you can, the instructions are here on this screen. You type in www.slido.com, and the number code that you want to be putting in is 5471978. But it might be easier to just use the QR code on your phone if you've got that handy. But if you're joining today on the phone, that might be more difficult. It really is purely just to break it up and have a little bit of fun. But so if you feel like you can't manage this because you're on your phone, that's perfectly fine. You don't need to do it if you don't want to or you can't. Does anyone have any questions or having any difficulty logging in and joining the Slido?
Nothing on the chat line, all good to go.
Right, all right. Well, if it's okay, then I might move to the next slide, but if you want that QR code again, just let me know and I can go back to it. Okay, so just a little bit of fun today. How do you feel about financial reports? You can choose which dog you feel most like tonight in relation to learning about financial reports. There are 6 kind of possibilities there for you to choose from. And just put the number in that most aligns with how you're feeling today. You know, maybe you're feeling a bit sleepy because it's a bit late, or, you know, maybe you're a bit happy about it. Let me know.
Just saying no active polls at the moment. Is it meant to be on the Slido?
Is it not working?
Oh, now it is. Thank you.
Oh, okay. I obviously had to move to the next screen for it to activate. So hopefully you've remembered which dog you wanted to be most like tonight. All right, I think we've got 5 people who have responded. Okay, so the most number are feeling like dog number 1. And then we've got a few who are also feeling like dog number 2, 3, 4, and 5. I think those numbers are not quite adding up. But anyway, it's just a bit of fun. So thank you for doing that. Let's go back and look at dog number 1. Okay, you're under the blanket. All right, so what we're going to be doing today is just looking at the basics of financial reports, getting some tips on how to create a budget if that is something that you need to do, and hopefully give you some greater level of confidence in navigating the financial health of the organisation that you are on the committee or board for. Okay, so let's get started into the main part of what we're talking about today. And it is important that you do have some level of financial literacy as a board director or a company director or even a committee member of an incorporated association, because there are some duties that we have as committee members that you have to comply with. So the first is a duty to exercise reasonable care, skill and diligence in carrying out your role. And so understanding the financial health of your organisation is a component of that reasonable care and skill and diligence. There is also a duty to not be trading while you're insolvent. So if your organisation is running at a loss and you're not able to pay your debts, then that's considered being insolvent, and that's actually illegal, and you're not able to be trading while insolvent. Obviously, we don't want fraud to be happening. So if you have some level of understanding of the basics around the financial statements of your organisation, that will provide hopefully a little bit of control against fraudulent behaviour, because there can be some personal liability potentially that you might have if there is fraud that occurs while you're a board or committee member. But you know, they're the serious aspects to it. But the kind of less concerning aspect is about it informing board decision making. And I think it's quite important that all boards, committee members understand the sort of trends around the financial health of the organisation, because that informs decisions that you might make as a board. So we have another Slido question. This one is, how confident are you that you can determine the financial health of your organisation right now? And so I guess I'm talking about, you know, if you're on a board, the organisation that you're on. If you're not currently on a board, or, you know, but you have in the past been on a board or committee, then think about that in your answer. But if you're not on anything yet, then it's probably a bit difficult to answer. But, you know, theoretically, how confident do you feel at the moment that you could apply for a board role or a committee role and understand the financial situation of that organisation? So if you could answer that question on Slido. Okay, so we've got a couple of people who are not at all confident. No, we've got a pretty strong majority feeling, pretty confident. So that's good. Why are you here? So that's really good. Hopefully, I'll be providing you with some information today that might be additional to what you know. But you're all pretty optimistic lot by the looks. All right. Well, in a survey of financial literacy that the Institute of Community Directors did, they found that 33% of respondents said that they could determine an organisation's financial health, and 18% that they said that they could apply financial ratios, which are the formulas that are commonly used to assess how well an organisation is doing financially. So we had like 60% say that they were pretty confident. So sounds like you're kind of doing better than what the majority have found in that survey. So good on you. I'm not going to go into a lot of detail, but we will be sending out this PowerPoint as a PDF document after the webinar. And so I thought I would include some definitions of key terms there. I'm not going to kind of run through each one, but as we go through, if I'm referring to any terms that you're not kind of sure about, pipe up and we can go back and check the definition of that term, and you can also have it available to you later on. So there's actually quite a long list of definitions. So, for example, financial statement is the written report of an organisation's financial activities, and that can include balance sheet, income statements, cash flow statements, and profit and loss statements. So that's what we're going to be looking at predominantly today. So let's get into the 5 key questions, which actually go to those financial ratios that I referred to earlier, which are the kind of key things that you want to be asking. So these are not the only questions that you might want to ask as a board director or a committee, but they're certainly a starting point, and they can start a conversation with either the rest of the board, or your accountant, or your auditor. So I'm going to go through a real life example, which Katie sent out to you so that you've got that available to you as well. So it is actually an example of a golf club. I've changed the name, but it is actually a real life example. If you are currently on a board or a committee and you have access to your own financial statements, then I really encourage you to kind of have that open, if it's on your screen or a hard copy in front of you, so that you can go through and have a look at your own financial statements as I go through this example, so that you can have a look at how you might apply it in real life to your particular situation. So open up your balance sheet and profit and loss statement, and we can go along. You can have a look at it as we go along. But what I'll be doing is sharing my screen with the example of the golf club, which we'll be using as the example. So I've called it the Green Grass Golf Club, which is obviously not their real name, but we will be going through their example. So what I'll be doing is I'll go through what it looks like on the PowerPoint, and then I'll stop sharing my screen with the PowerPoint and I'll start sharing the PDF document, and we'll go through it each one by one with the 5 key questions. So the first key question, which everyone always wants to know, is my organisation going bust? So really that is about, the overall financial sustainability of the organisation. So we need to go to the balance sheet for this particular one. Sometimes it's called assets and liabilities sheet. And we want it to be positive, not negative, with the net assets figure. And then we need to go and look at the profit and loss statement and find total expenditure. And we use those 2 figures with the formula dividing net assets divided by total expenditure to give us a sustainability ratio. And what that does is it gives us the percentage of financial reserves that we have available, how big a financial buffer we have with the organisation. And ideally, we want to have a ratio of over 0.5, which is 50%. So what I'll do is I'll show this to you in real life so that you can actually see what I'm getting at here. So I will now open up and share the PDF. So, that formula was we had to go to the net assets figure. So that's actually on the 3rd page under the assets and liabilities statement. That's the balance sheet. It could be called balance sheet or it could be called assets and liabilities statement. And you can see we've got total assets. We've got current assets and non-current assets. And then we've got current liabilities and non-current liabilities, which ultimately gives us a net assets figure. So it's the net assets figure that we're looking at for this particular formula. So in this example, so we've got 2 years here. We've got 2024 and 2023 in these examples. So we've got 2 figures there for each year, the net assets. So we want that to be positive. So in both those years, that's positive. It's not negative. So that's a good starting point for this particular example. And then you recall the formula was net assets divided by total expenditure. So total expenditure is back up here in the profit and loss statement at the bottom there, total expenditure. So the actual formula was net assets divided by total expenditure. And I said that anything over 0.5 is good. So in this particular example, in 2023, the financial statement, the total expenditure as a percentage of the net assets was 1.23. So that was very good. Then you can see it actually went down in 2024 to 1.08, but it's still way over the 0.5. Which is 50%. So this is basically saying it's over 100%, which is very good for this particular example. But if your example, if you've got yours open and you're doing your own calculation and you're getting a figure that's more like 0.5, that is perfectly fine. As I said.
Natasha,
yeah.
when you've we've got a question.
Yeah.
What is a non-current liability? A liability that is in the past or the future, but is not current?
So liability, non-current liability.
Yeah.
So in this particular example, the non-current liabilities are lease liabilities, employee provisions. So what they mean by that is maybe provisions for long service leave or sick leave, and borrowings. So that is, debt that they've borrowed. And they've also got in here some hire purchase liabilities. So basically what that is future payments, future liabilities that they might have to pay, that they need to kind of potentially put aside to be able to pay that. Does that make sense to the person who asked that question? Actually, it probably doesn't, because I've just seen that the current liabilities also has lease liabilities and employee provisions in it. So I haven't fully explained that. So current liabilities is money that an organisation owes and is required to pay back within the next 12 months. So that includes loan repayments and money owed from the purchase of goods and services. Non-current are things that are that you are not going to kind of required to pay immediately. So they're sort of longer term liabilities. So hence, so for example, the employee provisions in the current liabilities might be, the things that you've got to pay immediately, whereas the employee provisions in non-current liabilities might be those kind of like long service leave, the sort of longer term provisions for employees that you need to do.
Thank you. I'll let you know if there's any further comment.
Okay. Thank you. All right. So I will just stop sharing that one and we'll go to the next one. I need to share my screen. All right. So we've just done question 1, which is the sustainability ratio. So the second question, do we have enough money to pay our debts? For this particular ratio, we need to look just at the balance sheet. Both the numbers we need to answer this question are on the balance sheet. And that is current assets divided by current liabilities. So this gives you the number that indicates how easily you can meet your short-term debts, which is the current ratio. So how we look at that is it gives us a number. So if the number is 3.5, then that means that for every dollar the organisation owes, you have $3.50 to pay for it. If it's 0.25, then for every dollar that you owe, you only have 25 cents to pay for it. So obviously we want a ratio over 5, really over 1, sorry, preferably over 1.5. That's kind of like the industry standard. So we will go back to our example. And I will share my screen again. I think I really need 3 monitors but this particular one, 2 monitors just is not enough. All right. So this one was about going to the balance sheet, which is that second document, assets and liabilities, and looking at the current assets. So that's here, the total current assets, and dividing that by the total current liabilities. So that's this formula here. So in 2024, this particular organisation had a lot less assets. They had kind of half the level of assets in 2024 compared to 2023. But their liabilities were also less, but not half. So that means that the ratio that they have has changed between 2023 and 2024. So in 2024, they only have 0.55, which is not looking too healthy. It means they've only got 55 cents to pay every dollar that they owe. And in 2023, it was 0.99, which is, you know, better, but still not the desired 1.5. So this particular organisation, in answer to the question, do they have enough money to pay their debts? Not in terms of a short-term kind of cash flow perspective. So if they suddenly had to pay all their debts, they wouldn't have the cash to be able to do that. Any questions on that one, Katie?
Not so far.
Or anyone else? No?
Please
that
feel
makes
free
sense to people?
jump in.
I mean, obviously, you know, I'm not kind of, I've done the calculation previously and put it in here rather than kind of actually show you the calculation live. But, you know, if you've got a calculator available, you know, on your phone and you can be doing it for your own organisation, then please do that.
Just got another question from Janet. If a company does not have enough assets or money to pay all their debts, does that mean they're technically bankrupt?
They're insolvent, but what we'll do is we'll go through a couple of other examples around other ratios to help inform that, because it's not just about cash, it's about your total assets. But we'll be covering that in one of the next ratios that we've got. So I will just go back to the slide and share my screen. So once we go through the 5 questions, we will come back to that question, Katie. So if you can just kind of pause that one and we'll come back to it. All right, so the third question is how much cash do we have? So for this one, you want to have a look at the cash in the bank that's listed on the balance sheet. But you also need to consider what percentage of that cash is earmarked for future activities. And so this ratio is called the net cash ratio. So we look at that cash figure, but we take away any income in advance that is on your balance sheet. So what that is it's things that you owe in the future that needs to come out of your cash. So think of it as being you've got savings in your bank account, but you've got to pay your rent. So you've got to make sure that you've got enough money in your bank account to be able to pay the rent. So what's your net cash position minus, you know, your kind of liabilities that you have to pay in cash in advance. So that's kind of anything that can't be spent yet because there's a future obligation attached to it. So it could be that you have to have certain, like, for example, government grants or donations are often tied to spending it on certain things. So you have to spend it on those things that you're required to spend it on. And so when we look at this particular example, we just want it to be positive. It doesn't really matter what the quantum of that positive amount is, just so long as it's positive. So we'll go back to our example. So as I said, we wanted to look at cash, which is here under current assets, cash and cash equivalents. So here in 2023, they had 900,000 cash. In 2024, they had 400,000 cash. So they've gone down in their cash. And then we go down to liabilities and we look at the income in advance. So you can see in 2023, they had things that they had to spend that cash on, equivalent to slightly less than what they had in 2023. But in 2024, it was 600,000. So they had 427,000 in the bank, but their income in advance that they needed to spend that on was 600,000. So we actually have a negative of 185,000 in 2024, but it was positive in 2023. So that's an interesting story. I don't know why that is. So that's something that maybe if I was on the board, I'd want to understand a bit better why this particular organisation went from kind of positive to negative in 1 year.
Natasha, we do have another query about the being insolvent and bankrupt.
Yep.
If they do not have enough money or assets to pay their debts, they are insolvent, but it's illegal to trade whilst insolvent. So what happens?
Yes. So they really need to be winding up the organisation if they don't have enough assets or income or cash in the bank to be able to pay their liabilities. But like I said, we're going to be coming to another ratio that will help understand that. So we will come back to that particular issue in a minute.
Sure. Thank you.
That's all right. And I'm happy to, once I've gone through these 5 questions, to maybe, have a bit of a conversation about that with people. Okay. So we just did the cash one, didn't we? Oh, hold on. Did I share my screen? Can you see there we are. Okay. So we've just done the cash one. So the 4th example is how dependent are we on government funds? And this is a common issue for not-for-profits that are receiving a large amount of government grants. So it's kind of a question that's kind of pertinent for organisations that receive government funding. If you don't receive any government funding, then you're not going to kind of have this as a question that you're going to be asking, or you're not going to be able to do the calculation because it won't be available in your particular statement. So this is looking at the profit and loss statement. So we go back to that first one. And the formula is the the amount of government grants divided by total revenue. And in order to get a percentage, we multiply that by 100, and that gives us the percentage. And so the higher the number, the higher the impact if that funding ends, if you don't get that funding or the funding is reduced. So ideally, you probably want to be aiming for less than 50%. You want to have kind of a diverse range of income streams, and that provides a little bit more of a buffer if the government grant that you receive changes. However, there are a lot of industries, for example, sort of disability and aged care, where they have a very high level of government grants. So just because it is higher than 50% doesn't necessarily mean it's bad. It just means that you're more dependent on the government grant that you've got, and you just need to be aware of that as a board member around what the implications that might have for your business. And so effectively, this is called a dependency ratio. You can actually apply this ratio to any form of income streams. If, for example, donations, or if you're a member-based organisation, membership fees, sponsorship, you can kind of apply the same formula to a variety of different income streams. So let's have a look at our golf club example. So it was on the profit and loss statement, which is at the beginning. So here it says grants received. So that's government grants. In 2024, they didn't receive any. So that's really good from that perspective. We can't actually apply the formula to this in 2024. However, in 2023, they did receive 3,300 in government grants. Now, given the size of this particular organisation, they sort of, got figures in the millions. 3,300 is a very small percentage. It's actually only 0.24%. So this particular organisation is not at all dependent on government grants. But as I said, depending on the not-for-profit that you might be in, that could be, anywhere from 50 to 100%. So it is okay for it to be a much higher percentage if that is the type of industry or normal for your organisation to be reliant on government grants. Okay, and then our fifth question. Carry on, just there we go. Okay, so that was government grants. And then the fifth question is, how efficient is our fundraising? So again, not-for-profit might be quite interested in how it raises funds other than, getting government grants. And so we have a lot of generally not-for-profits investing a lot of time and resources into fundraising. And I'll give you a ratio here, a formula that helps you understand, are you getting, good bang for your buck in terms of your fundraising effort. So you want to be looking at the fundraising expenses divided by the fundraising revenue, and you multiply that by 100 to get 100%. So if you're getting a ratio of 100%, then you're basically running at a loss for that particular item. 50% is okay. Really, the lower the better. So you'd probably want to be trying to get closer to 20% if you can. And again, you can apply this formula to other types of expenses if you don't have fundraising expenses. For example, you could look at it from the perspective of marketing. You know, how efficient is your marketing? What's your marketing expenses versus what income you're getting from that? So it really just gives you an ability to compare how much revenue you generate from a particular set cost. So let's go and have a look at our golf club example and see how they're doing on the fundraising side of things. So again, it's in the profit and loss, in the income. We've got sponsorship, functions, and fundraising. So in this particular example, they've kind of lumped in a couple of things. They've got fundraising in addition to functions, which I'm assuming because it's a golf club, that's probably revenue they're getting maybe from weddings or something. And then they've also got sponsorship. So this one less clear in this particular example because it's all kind of like lumped in together. And then the expenses, it's not overly clear, but I've picked out advertising, membership, and My Club, which is a golfing app. The expenses associated with that as being what I want to use as my formula, my items for the formula. So in this particular one, we've got in 2024, we had 23,500 expenses for advertising, and then the revenue we got from fundraising and sponsorship was 28,000. So that's a pretty good ratio. We multiply that by, we divide those two, we multiply by 100, and we get 83%. Not hugely efficient, as I said. We want to be, more sort of under 50% as an ideal. So this particular example is not showing a hugely efficient process around the cost of advertising compared to the income received from fundraising. But this particular one is a bit murky in this example because there's a few things lumped in there. So if you're on the board of a particular organisation, you might be able to drill into that into a little bit more detail because you're actually going to have potentially a more detailed statement available to you. So they're the 5 examples that, or the key questions. What I wanted to do was maybe put you into breakout groups to have a conversation about if you were on the board of this particular golf club, or if you've got your own financial statements that you've been following along as we go along with your financial statements. What were some of the questions that might kind of doing this analysis raise for you, and how might this help with your decision making as a board? Excuse me. And what questions might you want to ask the accountant or the auditor? Sorry, I'll just... But before we go into the breakout groups, I just want to circle back to the couple of questions that we had about insolvent bankruptcy. Maybe the people who were asking those questions, if you can, take yourself off mute and maybe ask me the question, and we'll have a conversation about it.
Are you comfortable doing that, Janet? Or are you maybe don't have the facility?
Yes, I can do that. Can you hear me okay?
Yes. Yep.
Yeah. So my question is the one I just sent. So what checks and balances are there if a company trades while it's insolvent, and which is illegal, but the owners choose not to wind up the business and they continue to trade? Who or what? Hold on, you know what you're doing is illegal. Do they carry on?
Well, they're not meant to. They're meant to get in an administrator, and you know, if you're aware of this happening and they're continuing to trade while insolvent, then depending on what organisation they are and how they're, you know, what legislation applies to them, whether they're an incorporated association under state legislation or whether they're a company limited by guarantee under the Corporations Act, or they're a private company under the Corporations Act, or they're a registered charity with the Australian Charities Commission, you would go to the relevant organisation and you could make a complaint in relation to that particular organisation potentially trading while insolvent.
I'm sorry, you used some terms there that I don't understand. The types of companies you listed, I forget, you gave about 4 types of company, and I wonder, please, can you explain what the difference is between those, and who or what is the organisation that oversees them?
Yes. So what I'm trying to say is, depending on the company structure, there's a different organisation that can oversee them. So if they're a private,
what are they? Sorry. Yeah.
Sorry.
So there's a different organisation, you say. So what are the organisations? You said for a non-profit, and then you said a company. That was it. A company structured by guarantee or something. What is a company structured by guarantee? I know what a non-profit is, you know, and then I know what a commercial company is. But there's some other terms you used in that explanation, I'm sorry, that I don't understand.
That's okay. So a non-profit organisation could be an incorporated association, which is state legislation, the Associations Act, or it could be a company limited by guarantee registered with with ASIC, which is using the Corporations Act. So there are different types of not-for-profits, and depending on what their company status is, there's a different regulator for each one.
Yeah, different regulators. So who are the regulators? How many are there? What are their names? Things like that.
Yep. So for an incorporated association, it is the state government. So it would depend on what state they're in. And then who it is dependent on that particular state. So in South Australia, there's the Office of Consumer and Business Affairs. They manage the Incorporated Associations Act in South Australia, but it's a different government department in each state. For a company limited by guarantee that is registered through the Corporations Act, then it's the Australian Securities and I'm trying to remember
Investment
what
Commission.
the acronym is. ASIC,
I think
Australian
it's
Securities
Investment
and
Commission. I'm not sure.
Investment Commission.
Investment Commission.
Can't quite
I think.
remember what
Mm.
ASIC stands for, but there's that organisation. Then there's the Australian Charities and Not-for-Profit Commission. They regulate not-for-profit companies limited by guarantee that are registered deductible gift status charities.
Yeah.
So
Thank you.
a
Thank you.
not-for-profit could be any one of those three types of company types, and there are three potentially different regulators.
Okay, so thank you. So, can a company trade insolvent for, say, 1 year on the expectation that they will trade solvently, if you like, the following year, or are they pinged for, if you like, trading at all while they're insolvent?
So it is illegal to trade when you're insolvent. So as soon as you are insolvent, then you must be placed into administration. That doesn't mean that you can't then come out of administration and potentially, if you think that, you know, the next financial year you've got a lot of income potentially coming and you'll be able to trade again. But it is illegal for you to be trading as soon as you are considered insolvent.
Okay, thank you very much.
But if you are concerned by any of that, then I do encourage you to get both financial advice and legal advice on those two topics.
Yeah, thank you.
No worries. Any other questions before I move into the breakout groups? Although I noticed the time.
Yeah, we have.
We might not be able to have time for breakout groups. So maybe rather than going into any breakout groups, I'd be interested in hearing anyone's views about, as we went through those examples, what were some questions that kind of you thought you might, if you were a board member of this particular organisation, you might want to ask further questions of management or of fellow board members. Anyone have any thoughts about, in going through that example, some concerns or issues that they might want to delve into a little bit more detail if you were a board director of this organisation?
I'll give everybody else a chance to talk things.
Sorry, Janet, we didn't quite catch that. Did you want to say something?
I'll just give everybody else a chance to ask a question for a moment. I have got a question, Janet. But I'll give other people an opportunity to ask.
Okay.
Thank you. So, Louise?
I'd probably ask, where's all the cash gone, and why has property, plant and equipment worth $1 million more in 2024 than it was in 2023? And did that have something to do with where the cash has gone?
Yep, great question.
Well, from my point of view, coming from a very low base of understanding, so I found those ratio formulas something that I will have on as reference for when I'm presented with something like this in the future, because it did make it clearer for me. I've never quite understood how to make the numbers work. So thank you for those references.
Okay, thank you. Janet, did you have another question you wanted to raise?
Yes, I did. Can you still hear me okay?
Yes, yep.
Good. I think you sort of mentioned it. They've lumped some things together. Under income, they've got sponsorship, functions and fundraising. I would ask if they could separate those. And then under expenditure, they've got advertising, membership, and My Club expenses all together. They're not insignificant amounts, so I think it would be illuminating if they could separate those.
Yes. Yep. Good. They're all good suggestions. I might just I'll just share my screen again. Certainly, and I have to say that this was just a random golf club I picked. So I'm not on the board of this particular organisation, although I do like to play golf. But one of the things that I thought was interesting, kind of getting to your point, Janet, about kind of the solvency. They don't have a huge amount of cash in the bank, 400,000. They have, as Louise quite rightly pointed out, suddenly got $1 million worth more of property, plant, and equipment. And so whether they're insolvent or not, they've got a very positive net assets amount. But really, the majority of that is kind of tied up in non-current assets, which means that they're not very liquid. They're assets that you would have to sell off. And this being a golf club, you don't really want to be selling off your property and assets, because that kind of means that it might be difficult for you to actually run the golf club. So I guess one of the questions I would ask if I was kind of on this board, I'd kind of go, well, yes, in theory, we look pretty good because we've got, a very positive net asset position. But the majority of that is tied up in sort of, equipment and property that you can't easily, turn into cash. So that was just one thing that kind of leapt out to me for this particular example. All right, let's move on so that we can get you back to your families in a timely manner. Okay, so we will just quickly run through, and I might run through this kind of a bit more quickly. So feel free to jump in if it's kind of we're going too quickly. So some warning signs that you might want to have a look at when you're, looking at a board role or you're on a board. Lack of cash flow forecasts or multi-year losses where you're possibly using up your savings to cover any losses. An increasing amount of debt where your liabilities are greater than the value of your assets, or you've got unpaid bills. External people like suppliers might change the way they behave with you, asking for cash on delivery, or maybe the bank might want to start monitoring you more, or there are incomplete financial records or disorganized internal accounting practices. The financial auditing is not occurring regularly every year, or there are some unexplained discrepancies, or you are asset rich but cash poor, so you're selling off your assets to pay for operational costs. So they're just some examples of warning signs that you might want to kind of look out for. So we're going to quickly go through creating a budget. So this is a very simple process. And so this is really for people who really, maybe you're a startup, not-for-profit organisation, or you don't really have kind of good budget process in place. So this is just a very simple process to go through. So look at last year's income. Look at the timing of last year's income. So is the income all coming in regularly every month over a 12-month period, or is it lumpy? Is it all kind of coming in the form of a government grant, you know, at the beginning of the year, and then you don't have any income over the rest of the year? So have a look at the timing of when you receive your income. Think about, well, what will happen this year? Will it be the same or will it be different? And working out overall what your figures are for the year. So what your total income will be, and then detailing that month by month. Now, you could just average your total income, divide it by 12 and have kind of, you know, that as your monthly income. Or instead you might want to say, well, we actually get our income quarterly. So we'll put it in the, you know, the months that we get it, the four times a year, rather than averaging it over 12 months. Then you do the same for your expenditure. It might be worth getting some advice from your accountant, and then present that to the board for their sign off, preferably before the financial year, or if you're on a calendar year, whenever your financial statements are made, presenting that to the board for sign off before the beginning of the financial year. So that's just a very simple process. Some of the common mistakes that I'd like you to avoid: being a bit too ambitious with your projections around what your financial income will be, and then underestimating what your expected expenses will be. So try and minimize the difference between that, and sort of maybe probably better to overestimate your expected expenses and underestimate your income rather than the other way around. Another common mistake is that people kind of do it at the beginning of the financial year, but then they don't track it through the 12 months of that financial year. So you really want to be tracking that regularly, monthly, or at least quarterly, against what your budget was versus kind of what your actuals are, and comparing the two. Ignoring kind of trends, just taking a snapshot of each financial year, and not necessarily looking at kind of trends over several years. Not having a contingency, which is a cash buffer for any unexpected expenses. So, you know, having a 10 or a 20% contingency sitting there for unexpected, you know, like a petty cash piggy bank. And then the lumpy cash flow, as I mentioned, where it might be not regular every month, but goes up and down. And so if you focus on the total budget and not kind of look at when income is received and when you know, large expenditure is made, you can sometimes get yourself into a little bit of hot water. So if you're looking for a government grant, I'm going to give you a few tips about how you might want to create a budget to demonstrate how much money that you want to receive from the government, or from any other kind of you know, corporate funder. So when you apply for funding, generally they'll expect a budget that details kind of how you're going to spend the money on what. So sometimes they will have specific exclusions that they won't allow you to spend the money on. Some common ones are payment of office rent, for example, or the purchase of capital equipment. That can be a common one as well. So you've got to make sure that you're not including anything that is specifically excluded. If there isn't anything specifically excluded, then make sure that you include indirect costs, what your overheads might be, travel costs, if there's kind of travel associated with what you're seeking to do, including a notional cost for your volunteers in addition to the actual costs of reimbursement that you might provide to volunteers if you have volunteers, the cost of equipment that you might want to specifically buy from this grant, and then any in-kind contributions. So in-kind contributions means things that, for example, you're not actually paying for, that they're not paying for as part of the grant, but are things that you might be contributing. So, for example, if you've got volunteers, then you're not paying for paid employees. And so that's a saving, but it's worth kind of having a notional figure in there around, well, what would it have cost if you'd actually used paid staff rather than volunteers? So that's called in-kind contributions. And so particularly government funders, but also philanthropic trusts quite often like to see an in-kind contribution being specified in the budget.
Natasha, just on that, another query that I also had too was,
Yep.
what's the current value of volunteer labour at the moment? How do you value the in-kind contributions?
Yeah, I'm going to, in the resources at the end of this, I've got a link to a few websites, and one of them is, I think, Volunteering WA, and they actually tell you what the current kind of value is. I think it's something like $20 an hour that you kind of value your volunteers at. So if you've got, 10 volunteers and they're volunteering for 10 hours, then that's going to be, $2,000 if it's $20 an hour.
Yeah. And Janet also had the observation that she comes across administration expenses as another one to remember as an exclusion.
Right. Yeah. So it's worth, having a look at the grant guidelines about what they'll include and what they won't include. And if it's not particularly specified, then include as much as you can. So that's my tip around budgets. So just some common pitfalls, having no line of sight between the budget and like the project plan. Like if you're submitting a request for funding to deliver a particular project. So let's say you're a land care organisation and you want to get some government funding to plant, 300 trees in a particular area. But your budget there's a mismatch there. The budget kind of suggests that maybe you're only going to deliver 100 trees. So, the funders will look at that quite closely. So you do need to make sure that your budget is consistent with kind of what you're asking for. Forgetting about in-kind, forgetting to include volunteer time or donated resources. Excuse me. Being unrealistic with your budget, either being too low or too high, can kind of raise red flags for funders. So they do look at your budgets in a fair amount of detail. Another thing that they look at is the sustainability of what you're asking for. So if, for example, in that example about land care, requesting, 200 trees, then that's just kind of a one-off project. And so they can kind of go, well, that's fine, we'll pay that. There's no kind of ongoing commitment. But if you're asking instead for a project to deliver services to at-risk kids in your local community, and you're asking for 12 months funding to kind of pilot a new service, they're going to look at, well, if you're asking us to kind of pilot this, then you might expect us to continue funding this as we, go beyond the 12 months. So they're going to be looking at, well, how might you fund this in an ongoing way? So they're going to look at that. And then not having enough detail in your budget around some of the assumptions or how you've calculated certain things. So sometimes when you apply for a grant, they give you a spreadsheet they want you to complete. And so that gives you the expectation about the level of detail they want. But often they don't. And so it's really up to you. And I think, the more detailed, the better. It will give you a greater chance of winning that grant. Are there any questions on that?
Janet's just questioning some volunteer value work that she remembers from the ATO is about $85 per hour. I'm just trying to find a website that might shed some light on that. And Lou Stock has suggested that figure seems quite high. And she did an application the other day that specified $40 an hour, and that was and another one that was $30. So $85 an hour in 2023 sounds quite high. But there
That
must
sounds
be
high to me. I think the $30 or $40 sounds a bit more realistic. But I do have a link in the resources, so we might have a look at that in a minute.
Excellent, thanks.
So my key takeaways for you is that really all board directors should have a basic understanding of the financial health of their organisation. You can't just rely on if you've got an accountant on the board or committee and them kind of being okay with it. You've got to kind of do your own due diligence yourself. So like I said, those key ratios help you understand a little bit about the financial health of your organisation. You should be monitoring the financial data regularly. Some organisations do it monthly, some do it quarterly. It doesn't kind of really matter so long as you are doing it, reasonably regularly throughout the financial year, because it will inform decisions that you might need to make as a board. You can't delegate your responsibility as a board director, but you can seek advice from accountants and financial experts and lawyers as well. And when you are setting your budget for the next financial year, make sure it's realistic and it does include all costs. So I guess just to kind of reinforce what we've covered today, I've got kind of 4 key questions that I think that you might want to ask yourself about, the board that you're currently on or any future board or committee that you're thinking of joining. So I think the first question is, well, where does our funding come from? So if we're highly dependent on one source of income, like government grants or membership fees or whatever it might be, then that kind of gives us an indication about kind of how reliant we are on that particular factor around the financial health of our organisation. So understanding where the funding is coming from is important. The second is to kind of look not just in one financial year, but over a trend over a few years. Has our funding gone up or down in recent years? What's happening as a longer term trend? Thirdly, if we're a not-for-profit and we are dependent on fundraising, what is our strategy around that? And are we being diverse in the sources of fundraising that we are looking for, and how we're doing that fundraising? And then lastly, do we have enough cash to pay our debts? That's kind of quite fundamental, getting to that point of whether you're trading while insolvent. So I do have some free resources available. So the Institute of Community Directors Australia have a lot of help sheets and tools on finance in particular. They have a lot of help sheets and tools across the board, but they're a very good source of information that's easy to understand and focused on the not-for-profit sector. So there's a link there to them. So the City of Sydney have a grant budget template that you can use and modify for your own purposes. It's an Excel spreadsheet. And then Volunteering WA is the one that I was referring to around the in-kind calculator. So I'll open that up in a minute. I've also given a link to a publication on understanding company financial data from PwC, PricewaterhouseCoopers. And then if you're interested in sort of online courses, Wall Street Prep have courses and tutorials and guides on accounting. Those two ones are quite detailed and are not kind of pitched at the kind of basic level that we've pitched at today. But if you want to go into a bit more depth, then I recommend those two. So let's open up the in-kind calculator. So it is saying, here we go. So it's depending on the age of the volunteer. So they're saying between 15 and 25 years is $20 an hour, up to $40 an hour for over 65. But the highest is what, 45 to 54 at $57 an hour. And then they've given an average of 48. So it is in that sort of $40 to $50 an hour range for what they're suggesting is the notional cost as an hourly rate for a volunteer. Hold on. Can you see that? I might not have actually shared.
No, you didn't share it, but I thought you were
share.
just saying it. So that's probably.
Sorry about that.
No, that's okay. We got all that information.
Can you see that now?
Yep.
Yep. So this is the Volunteering WA calculator. So you can actually just pop in your figures and out will pop the calculator. But they are saying sort of between $20 and $57 an hour, depending on the age. And then if you wanted to just have an average across all age groups, they're saying $48 an hour. So it is in that sort of $40 to $50 an hour range. All right. I think that was everything. Oh, we've just got a Slido poll, but we can skip that. So we will just quickly, I'll hand over to you, Katie, to talk about upcoming masterclasses.
Thanks very much, Natasha. That was very informative. I personally found it really interesting, and I'll be looking at those ratios, as I said, and even that in-kind calculator will be really good for grant applications. And I know that there's a lot of information that will be useful when we send that out to everybody so they can refer back to it. I would like to just quickly advertise some upcoming board governance workshops we're having in Naracoorte in early May for you to, spread the word. There'll be full day governance masterclass with Kate Teely. So that'll be looking at all the, I haven't got all the final program yet, but that will be on our website soon. And then 2 workshops held the next day, practices of high performing boards and how to secure a position on a board. So keep an eye out on that. They'll be very good value, probably free. So really well worth it if you're looking at a company director's sort of course in a different format. That's all I have to say. I will be sending out a feedback survey. I might just do that in the email.
Okay.
by all means jump on now, but I will be sending that out anyway.
All
So
right.
that needs to be updated with the date, but it's the same one. So
Okay.
I'll send that out tomorrow with the recording, and everything will be available on our website later in the week.
All right. Are there any more questions either in the chat or if someone wants to ask a question now before we finish up?
There are currently no questions in the chat.
Okay. No other questions?
There's
right.
one you missed.
Well,
No more
I
questions.
hope you found that helpful. As I said, it was kind of a little bit basic, but I've given you some resources there for you to delve into more detail if that's something that you're interested in doing. All right. Well, thank you, everyone. And I really appreciate this is the final of the 4 workshops that I've delivered for MFMG. So it's been a pleasure. I think each time we've had kind of a different group of people. So it's been really interesting. And I've really enjoyed working with you, Katie. And I wish you all the best for those masterclasses that you are doing later in May.
Thank you very much, Natasha. Thank you very much for presenting over the last 4 modules, and we appreciate all your work.
Thank you. All right, I'm going to stop the recording